Good afternoon, everybody, and welcome to the latest webinar from CFA Society Minnesota. We're delighted to have our friends Stacey Gilbert and Sean Heron from Glenmede Investment Management today talking about volatility. I'm going to get out of the way very, very quickly, simply going to do really quick housekeeping item and thank a couple of folks. First of all, we are going to use the chat function today for Q&A. Megan, could you advance to the next slide really quickly so I can do a couple of other thank yous, specifically to our annual sponsors, the firms you see on the screen here, RBC, DGI, Nuveen, Securian, et cetera, some names you will recognize in the group. These are the folks who every year contribute their time and talent and treasure to make sure we can continue to provide professional learning opportunities like today. So we thank them profusely for their support. And one other thank you, next slide, Megan. We need to give a special shout out to CFA Institute. You may or may not be aware of this. CFA Institute, when the pandemic hit a few weeks ago, they immediately rushed and made a Zoom meetings license available to our society and a number of societies around the world. And that enabled us to continue to deliver professional learning activities like today's webinar. With that, I am going to get out of the way. Thanks again, Sean and Stacey. Take it away.
Great. Thank you so much, Mark, Megan, and thank you to everybody on the call today. I know Sean and I are incredibly excited to talk about volatility. So one thing I just want to stress, yes, my camera is on, and I have to admit that it's a little awkward for me to actually see myself talk. I didn't realize how much I use my hands when I talk. So if it goes dark, it's just because I'm tired of seeing my hands fly up into the screen here. But what I wanted to mention is that Sean and I have spent our careers in this industry, and the one thing we're very comfortable with is questions. We've both taught, whether it be at the university level teaching derivatives. I've taught a number of traders over the years how to trade thinking about derivatives. So I want to encourage questions throughout this entire presentation. If something pops in your mind, throw it in the chat. If you are not comfortable posting it publicly, please know that you can reach out to me, Sean Heron, or Jason Laird. Any of us are happy to take your questions and post them in the chat there. So when we initially started this conversation, we wanted to talk volatility. We promised not only to answer basically how we got here, but how can we expect to get back to normal? So when we're thinking about what we believe to be normal volatility, we're going to go through a couple of different slides here. And we're going to start with just really, we have to understand how we got here and kind of what we define normal and how we're going to eventually get back to this normal. So the very first slide that we're going to look at here is going to be that of the VIX. Perfect, thank you. So this is a chart of the VIX. This is the SIBO Volatility Index. It's often referred to as the VIX. It's kind of the nickname here. And really what it's looking at is a basket of 1-month options on the S&P 500 index. And it really calculates a quote-unquote best guess of future volatility over the next month. The index, obviously, what it's looking at is the S&P 500. And it's often referred to as the fear index. You click on CNBC, and once it breaks a certain level, everyone starts going crazy that the fear index has spiked. For those of you who may have seen our video on the Bumpy Road to Normal, we actually really consider this index a really good measurement of uncertainty. So it's not just fear, uncertainty, and that uncertainty can be both to the upside and the downside. The higher the value, the higher investors' uncertainty to future price moves. And this is going to become really important as we kind of go through the history of where we were and to where our expectations are in the future. The various volatility indices, I should mention, so we're talking here the VIX. We'll talk about the VIX most of this presentation, or volatility on the S&P 500, but volatility is obviously everywhere. It can be treasuries, oil, small cap, etc. But again, just for this presentation, because it's the most commonly discussed when referring to volatility, we're going to talk about S&P 500 volatility, or the VIX. So when we're looking at this chart, let's kind of focus and you can say, Stacey, get focused here. Let's get focused at what we're seeing here. The orange are days when the VIX closed above 40. And 40, it's just really, it's an extreme level of uncertainty, an extreme level of potential movement. I often think of volatility as kind of the potential movement out there in the marketplace. A VIX above 40, that would be intraday moves in the S&P 500 on average around 2.5%. So think about what we were experiencing in March and into April. Some of those days were 12% moves. So 40 VIX is a really high level. The blue days are when the VIX was below 40. So when we look over the past 30 years, and the reason we use 40 is it is really kind of the outlier. Less than 3% of the observations over the last 30 years have seen a VIX close above 40. And obviously the most recent observations were really during this COVID-19 driven market sell-off. When we're talking about normal, kind of this bumpy road to normal, how will we get back to a quote unquote normal environment? We would define a normal range in the VIX in that 15 to 20 range. That's kind of a healthy level of uncertainty. It's not complacency, which we saw in 2017 where you had the VIX get as low as 9, but it's not the uncertainty and clearly not the levels that we saw in March where we had new record highs in the 80s. And as it relates to this, it's really worth noting that while volatility in our extreme cases of 40 does not remain there for an extended period of time, and you can even see it in this most recent period, the path to the sustained 15 to 20 range takes some time. So I want to see, you can see here with that dotted line and that smooth red line, that's our 15 to 20 range that we're considering our normal range here. And when we look at the periods of those orange spikes throughout history, just notice how long it tends to take for the VIX to return back to a normal to a healthy range. Historically, and we'll look at this a little bit later in the presentation, it can take anywhere from 5 to 15 months in order for the VIX to kind of return to this normal level. I promise that this would be a glimpse into the conversation that Sean and I have every day. And for those of you who have not met us yet, one of the things that we do is talk a lot, all day long, talk about everything, particularly as it relates to the volatility markets. We believe that there's so much information within the options world, and we're constantly talking about the information that we're seeing and how we're interpreting this information. But what I wanted to do with this conversation is kind of give you a glimpse into some of these daily conversations that Sean and I have. So before I keep going, I want to give Sean a chance to talk here. So Sean, I'll turn it over to you.
Well, thank you, Stacey, for laying out our conversation. I want to begin with the 7 basic truths about volatility, then move on to a discussion about volatility risk premium before closing with how options markets are currently pricing in uncertainty through the end of this year. First up here, I have the 7 truths about volatility, which we use to help us understand kind of what goes on in the vol market and how to design products, but also how to design strategies around the most optimal ways. So here it starts with the first one: recent realized volatility drives future implied volatility. Basically, market adapts to current conditions. Second, implied volatility tends to exceed realized volatility. Volatility risk premium basically exists. Volatility tends to mean revert because markets return to normal. And fourth, volatility clusters in regimes. Basically, the market is episodic. We have low vol regimes and high vol regimes. And the real question is the transition between the two. Obviously, earlier this year, we had a transition from a low vol environment to a high vol environment. And over the last several months, we've started to transition back from high vol to less high vol. It's still high, but it's transitioning from extreme highs to just high. And then fifth, volatility regimes tend to transition. That's kind of what the market's moving over time, like I just said. Sixth, implied volatility tends to skew. Markets rise more often, but they crash much faster. So downside optionality tends to be more expensive relative to upside participation. And seventh, implied volatility generally has an upward sloping term structure because the longer you go out into the future, the more uncertainty there is about all the potential ranges that could present themselves. So now I'd like to move over to this next chart. Again, I'm moving a little quick here. If you guys want to slow me down during the Q&A, that'll be fine. But
wait, Sean, I just want to, Sean, let me jump in here real quick, only because we were encouraging questions throughout. So I just want, as kind of a break here, just to give you a chance, as I just went off on a diatribe about the VIX, to give you a chance to answer a question here that basically was, how can I use the VIX in my investment process? So we'll start with that one, and then again, we want to encourage questions. Feel free to throw them in the chat. We promise we will get to them as soon as we see them.
Just to let you know, since we don't usually use Zoom and we're more WebEx and GoToMeetings people, I can't see the chat when I'm sharing my screen. So it's your job to read the questions and interrupt me. Thank you.
Well, I just said, so you get to answer this one. How can I use the VIX in my investment process?
I think the starting level of the VIX is going to come in here on the next slide. And you can think to yourself, what is the available volatility risk premium? But also remember that the real question on a strategy's performance is, the future, not kind of the past or not the starting point. What we try to look for option selling strategies is that the VIX tends to anticipate more volatility or expects more volatility than what is ultimately received or realized in the market. So the volatility risk premium exists, and you can capture that by selling options. And ultimately, what this strategy is doing is taking starting levels of the VIX and saying, how much volatility risk premium should I expect to pay if I buy options and want to feel I received the protection, and how much volatility risk premium can I receive if I'm willing to sell options and expose myself to that uncertainty. And currently we have a VIX that's pushing 30, so we're in this fifth quintile on the far right. And in that environment, you can expect about a 6.5% volatility risk premium if you sell options, or a drag or a cost of 6.5% if you buy them. And that may seem like a big number, but remember, if you're selling options in this environment, you can earn more, but you also sweat a lot more as well. And in lower vol environments, you can get a lot less volatility risk premium. So if insurance is cheap enough, maybe you buy it. So now going back to the question, how can you use this? The simple answer is, if the VIX is low, it's at least cheaper to carry insurance protection. If insurance is cheap enough, you may want to just have some in case we transition to a higher vol environment. But once we transition to higher environments, there's a huge incentive to sell options and basically use the buffer or the volatility risk premium as a buffer to collect premiums that can cushion the market moves. Because if you pay these premiums, it could be a big drag if the market in fact recovers instead of continues to sell off. So basically monetize your hedges when volatility is high, and maybe purchase hedges when volatility is low, but recognize what you're really setting yourself up for is transitioning from high to low vol environments, and that the starting VIX is just the starting point, and the adjustments will probably have to come along after. Now, I covered a lot of this chart, so I won't beat this chart to death, but we can come back to it if there's any other questions about using starting levels of the VIX to sell options, which is what this chart tries to allude to. And I can come back to that. But first, what I wanted to do, because I want to give it back to Stacey in less than a minute, was kind of go across kind of the year-to-date performance of the S&P 500, and then how those the drawdown and recovery transpired, and what are the odds and what are the probabilities? Sorry, not the odds. What are the probabilities at the end of this year that we are at different levels of the S&P 500? So first here is just, we drew a line at the start of the year return. So all this is will the return this year be positive? And that's 32.37 is kind of where the S&P started the year. And there's a 45% chance as of June 19th, last Friday's expiration, that the market is positive at the end of the year. There is also a 15% chance that the S&P is below the recent low of 32.37 at the end of this year. A lot of people ask the question, oh, there's only a 15% chance we can retest the lows. And that's not what we're saying here. What we're saying here is there's a 15% chance we can finish below 22.37 at the end of this year. If you were to look at exotic options, so one-touch options they're called, there's actually about a 30% chance, or just under a 30% chance, that we could revisit the lows and ultimately end up recovering off of those lows before the end of the year. So there's a very realistic possibility of all potential outcomes, retesting the lows, staying positive. But again, this is just where the odds are saying for where we would finish the year. So there's a 45% chance we are positive at the end of the year. There's a 15% chance we're below the recent lows. And of course, the base case is there's a 40% chance we stay between these two levels. So with that, I wanted to give it back to Stacey because I wanted to kind of accelerate our pace so we can get back to the Q&A.
So Sean, actually, before you turn it back to me, if you can go back to the VRP page, question in the chat is, what is the distribution of the risk premium by decile? So if you want to talk about, I know we talked about particularly that the largest decile, you're looking at a very, very wide range. Any comments on the distribution of it by decile?
Yeah, so I like the question. I figured out how to get the questions up so I can read my own questions now. So I'm starting to get better with Zoom. The short answer is the range, especially the highest quintile. The range of volatility risk premium is extremely positive and extremely negative. It's extremely negative when you transition into it and go right through it. So when the VIX goes from 24 to 80. And it's extremely positive when the VIX goes from 80 back to 24. So the question really becomes is what is the potential range? And it's the largest when vol is the highest, which is the VIX in the highest quintile. I don't have a specific answer for the range because you would have to take all rolling 30-day periods, but it's safe to say it's anywhere from a positive, say, I'll rough this, 25% to a negative 25%. And one thing to remember, if you're using options and you're specifically using a simple like option selling strategy and a put rate strategy, that the extreme move in volatility can be contained with options because options will, at the extremes, turn into stock or cash, depending on whether you're betting against or for an up or down market, which means you can constrain or cap the potential loss in short volatility strategies by using options that simply convert into stock, and stocks can only go to zero. So there's ways to not be levered into the vol trade that this chart doesn't get into, but I think they're valid points.
Great, thanks. And so I see another question, and I think this next slide that we're getting to will somewhat answer this. So the question is, why do you think the VIX overstates future volatility? And I'm going to start with this chart. If it's not an answer to a particular chart,
Thanks. Maybe I can take this because you're breaking up. You're breaking up really bad. So I'll just take this next question and give it back to you. It was real staticky. So why do you think the VIX overstates future volatility? Well, there's two reasons. One is the VIX may not be the best measure for volatility to begin with because it takes in all potential outcomes. It's the range of all options, including the fat left and the fat right tail. Some people prefer to use more optionality, which are known as the near to money options, to kind of come out at a slightly lower number. But regardless of whether you use the whole normal distribution surface or just constrain it to near the money, what you ultimately end up finding is that the VIX overstates the future implied volatility or the actual implied volatility by between 2 and 4%. And I think the reason that exists is it's just a rational decision between option buyers and option sellers. A buyer knows they're paying it, but they get to remove uncertainty. A seller of options knows they're going to receive it for the risk they're taking, which is short volatility risk. So it's simply the compensation for exposing yourself to uncertainty that the seller gets and the buyer is willing to pay. These next couple slides will give a little more information about how the VIX isn't always perfect at predicting in the next month. So I'll give it back to Stacey.
So let me know if I'm not coming through clearly. I'm holding up everything to try to get as much of a signal as possible. So what this next chart is looking at is it's really the way that we're graphically trying to show volatility in two ways.
Stace, I'm going to have to cut you off. It's really bad. I'm so sorry. And you know I don't want to do this chart because it's yours. But I'm going to try my best, even though I am not as prepared as you are. But let me just kind of take a stab at this chart to kind of get into a Q&A and some questions. The S&P 500 implied moves monthly is depicted by this chart. And we call this chart our monster mouth. It's basically the range each month for the next 30 days that the options market is predicting. And you can see inside of this range, every time we get a blue dot, that's when the 1 year realized volatility was lower than what the market was predicting at the beginning of the period. Ultimately, the beginning of the period vol was higher than what subsequently happened. And you're able to have a positive volatility risk premium. So selling options works when you see these blue dots. Next up, we have the orange dots. And in the orange dots, you actually have volatility risk premium not working, or actually predicting volatility will be lower. And in fact, it ends up coming in higher. So in this case, you're getting extreme moves that are outside the expected bands. And the last 2 months, not the last two, I'm sorry, the recent drawdown and recovery, March and April, is when you saw the most extreme mispricing of option volatility and the pace of which the drawdown and recovery happened being more extreme than the market predicted. So first you would take a look here at March. There was a market expectation of about a 5% move when you look at the separation of these two lines. And that 5% move, ultimately plus or minus 5%, ended up being way too low because the market ended up falling over 30% during that expiration cycle. If you go fast forward 1 month, now the market has adapted, it's adjusted, now expects an S&P that will move almost 25% over the next 30 days. And it still was wrong, even with that major adjustment and much higher volatility. I'm sorry, it was expecting a 19% move, and it was still wrong because the market ended up moving 25. So again, it's this blue, orange dot up here circled in blue. So basically the drawdown and the recovery did two things. The drawdown was a crash. By definition, a crash is a market that goes down more than expected. And then the recovery was a snapback. A snapback by definition is the market recovers faster than expected. Those two things happening means the market didn't expect the volatility we got. You basically lost on both ends. So short volatility was in a very difficult environment, but actually the most difficult environment ever in the history of the VIX going back to 1990 because of these 2 months. Now, this chart, again, I can talk more about specifics, but the long road to recovery tends to be a great opportunity because following these extreme levels of volatility, as the market recovers, you get bigger option premiums because the market doesn't forget too quickly. That's, again, realized vol tends to predict future implied vol. So you get these elevated volatilities for several months. Back to the point of this whole slide was our bumpy road to normal is as we transition from the high vol back to the low vol, as the market recovers, it takes quite some time, and you can collect a lot of option premiums by selling options in a high vol environment. And it may not be the best time to be buying options. And if you tend to buy protection, this may not be the best time to monetize your protection because it was a few months ago. But if you get another chance to monetize your protection, just remember how expensive it is to carry. And you may want to consider the cost of carry to be too great and maybe even shrink the position or monetize the positions. Again, just being a better opportunity to sell options right now. So I got another question here. Last time I checked the performance of a couple of these S&P vol risk strategies that had materially underperformed the index for 5 to 10 years. Why? Am I wrong in the assumption that these have underperformed? No, you're 100% right. So if you looked at the last 10 years, the 7 years leading into 2017 was good for short volatility strategies because volatility got lower and lower and realized moves got smaller and smaller, and you collected and kept the premiums. It almost seemed like a free lunch for a while, but of course there's no free lunch. And then from 2018 through 2020, short volatility strategies have done horrible. They hit a very bad environment. So the question you have to ask yourself when evaluating these strategies, and you mentioned a couple, I don't know specifically which ones you're talking about, but were they built with staying power, meaning that they weathered the storm, or did they reveal their Achilles heel or under and basically cease to exist? So that happened with some of them. And if a manager performed well from 2009 through 2017, you could see that they performed well in an environment where we transition from high vol to low vol. But the real question is, how did they perform during a difficult environment, which was 2018, 19, and 20? And I think that tells you a lot more about the managers is, how you perform in a good environment, great, but how did you perform in a bad environment? And if the answer is better, then there's something to be said for your risk management skills or something like that. But I think that, yeah, short vol didn't work the last 3 years, and there's a big recency bias to think it's not going to work. But there's also a wonderful opportunity right now to get involved in a short volatility strategy as we transition to lower vol for 3 reasons. And now we have a short vol strategy, but I'm just trying to give general reasons here. The number of people selling volatility, the total AUM in short volatility strategies has shrunk. So again, there's less selling pressure. The buying demand for protection has increased because people are fearful of a double dip. The volume of puts is increasing with vol, and the volume of calls is increasing with vol, which means that there's, generally speaking, more buyers of optionality than sellers. And like I just said, the natural sellers that have been participating in all these strategies, they're seeing their AUM shrink. So there's less sellers and more buyers, which again lends itself to a wonderful opportunity to join the sellers, because that's where the advantageous pricing is right now. And we see that kind of playing out through the end of this year. And I do think some of the protection strategies that are just pure tail risk hedgers already had their victory lap in their day in the sun, because the tails are very expensive. And if I wasn't going to sell options, I'd probably lean on strategies that buy and sell options and try and let the spreading of optionality reduce the cost of carry of protection over time. Or I would just simply sell options because the buffers are pretty big, and therefore you can collect premium in a flat market, but also be somewhat more protected in down markets from the volatility risk premium. So with that, I'm going to just keep going. Sorry, Stace. Hopefully you can hear us fine. And buying at the S&P 500, this chart here tries to compare simply buying the S&P 500 versus selling insurance against the S&P 500. Remember, selling insurance against the S&P is actually exposed to two unique risks. The risk that stocks may go down, just like the S&P, but also the risk that stocks may move around a lot. And that second risk factor, since it's not 100% correlated to the S&P, can actually give you diversification benefits and also give you similar returns to stocks with less risk. And again, those premiums being bigger, the opportunity now might actually be greater than it has been historically. So this chart goes back to 1986. It just looks at the S&P 500 versus the CBOE S&P 500 put rate. You see similar returns, a little bit more than 9% for the S&P, a little less than 9% for the put rate, but you also see the put rate had about 2/3 the risk, a 10% standard deviation versus a 15. So this next chart we want to look at kind of what goes across different expirations and shows you in orange when it probably wasn't a good idea to sell vol, because you can see the spike in volatility. In the blue area was when it was a good idea to sell vol. But the thing you notice about all these flare-ups in volatility is how the S&P actually doesn't end up outperforming the put rate index in a lot of spikes in vol, because the put rate index is able to immediately adapt and then start collecting all those premiums and provide that downside cushion. So there's a downside cushion when the market draws down, but there's also a big premium to keep up with the recovery as the market snaps back. And that's why the put rate strategy actually has stock-like returns. And although it didn't totally keep up on the recovery over the last 3 months, it does tend to keep up on slower, longer recoveries. So sticking with the strategy can make a lot of sense. And you can see here some different dates where the put rate index actually kept up with the S&P during a decline, a drawdown, and a recovery. And with that, we're kind of done the presentation. I didn't do a great job covering Stacey's slides, but I hope we can open the conversation up to a few questions. And really, I would like for all the participants to challenge my range on derivatives. I mean, the questions don't have to come from the presentation. I can usually respond to questions, anything to do with derivatives, but it is my only trick. Outside of derivatives, I don't know as much, but I know a little bit about this, and I'd like to be helpful if I can.
Sean, am I coming through clear yet?
Yes, you sound clear, so just stay on the voice.
Perfect. I will just stay on the voice here. One of the comments I wanted to make about this slide here is we're kind of waiting for some questions. What's interesting about this, these orange spikes, if you will, these are periods where the actual premiums that you're getting from options was greater than 2%, and the blue is obviously less than 2%. We kind of alluded to this at the very start of how long does it take to normalize, and you can see these 3 periods here are the last 3 notable spikes where the VIX broke through 40 at an expiration. And you could see it was 5 to 15 months before we got back to a normalized level. And I know Sean's talked about this. Part of our expectation now is that we're in that longer range of closer to 15 months because of all of the uncertainty that's out there. And as Sean looked at the year-end probabilities, that wide of a range really is suggestive of uncertainty out there in the marketplace. I stalled long enough that we got a question here. Sean, if you want to take about the VIX ETNs.
Sure. So the question is the market structure. How will the market structure change as Credit Suisse retires their VIX ETNs? So Credit Suisse announced about a week ago that they're going to close TVIX, is probably the most popular one. And there's a number of other strategies. Some of them were commodity-based, gold and things like that. But specific to the VIX question, I don't think it changes much, although the size of TVIX and the popularity of TVIX sounded bigger than it was. I think it was popular because it was in the press a lot. And then most of the trades were paired off. So most of the volatility trades were paired off. So as the AUM shrunk or grew, it didn't really impact the underlying VIX market all that much because it was a very two-sided market already. I think it did impact Credit Suisse's balance sheet. And as a bank with a balance sheet, they had to be concerned. But I don't think there's a major market structure change. It does make it a little less convenient for retail to buy volatility in a levered way because they tend to stay away from futures and options and swaps. But they still can get exposure to long, just not levered long volatility through some other ETFs. And it seems like those other ETFs were popular as well. So I don't see a major change. I think Credit Suisse basically just waved the flag and said, hey, don't use levered exchange traded products because they're dangerous. And we don't even want our name attached to this stuff. And at first they tried to get Velocity shares to be a different name, but we all know that they are owned, not owned, but very linked to Credit Suisse. So the next question here is the volatility risk premium present in other asset classes besides the S&P, and is it easily measurable? Yes, the short answer is all the major indices. So think MSCI EFA, MSCI emerging markets, Russell 2000 small cap, S&P 500. They've all used, and I know there's a bunch of CFAs on this call, the robust test to make sure that you could allocate this across geographical regions and across different asset classes and large cap versus small cap and things like that. The volatility risk premium exists because people are willing to pay to remove uncertainty. And again, it's across all the indices. The reason the S&P 500 is the most popular is because when you create strategies that require liquidity, the most liquid indexes also being the most popular, that liquidity tends to concentrate around popularity. And it's also a good place to be because on the most liquid day, everything's fine. But on the least liquid day, the S&P might be the only place you can really get options done without a lot of market friction and impact from trading cost. So in March 20th, when we had to roll some expiration, and at the end of March, quarterly expirations, it was a lot easier to trade the S&P 500 than anything else. Basically, the market impacts were 5 times normal in a lot of single stocks and things like that. And they were, just 1 basis point in normal times probably went to 3 basis points in that volatile time. But the difference between 1 and 3 basis points versus 50 and 2% for single stocks was pretty great. So I think, again, liquidity concentrates during times of stress. And then the last question here.
Yes, I'll take this last question here about what do you find are common misconceptions about what the VIX is or isn't telling investors. I think the most important thing to think about the VIX is it's a 30-day number. So when we're trying to assess what expectations are for a longer period of time, the VIX isn't measuring that. And I think this is really important when we look at what happened from March to April, April to May, May to June. The VIX went from all-time highs in the low 80s to getting down to levels that were in the 20s. But importantly, as we looked out to year end, kind of the expectation for risk as we were looking at year end, that didn't move at all. So when I say that didn't move at all, it means as soon as COVID kind of had the market sell off, had that quick transition from the longest bull market in history to the quickest transition to a bear market in history, the VIX adjusted. Longer dated volatility increased, meaning the expectation for risk looking out 9 months had increased. As the market started and as we started to rally back, as everything started to start to open again, the VIX had declined. And if you were just watching the VIX, it felt as if, okay, the market's great, things are great, looking at a year end, things must be great. And the reality is that longer end number never changed. The concern as we looked out 6 to 9 months remained elevated. And there's just a number of different issues that are out there, not the least of which is a presidential election, which seems to be setting up for a potentially binary event in the stock market here. And we see that within the volatility levels that the VIX itself isn't capturing because the event isn't in the next 30 days. So the one important aspect to think about with the VIX is kind of what's going to happen over the next month. And when we're thinking about what's going to happen over the next month, it's so much easier to have a handle on events. What's going to happen over the next 6 months and the next year, we have to look to longer dated volatility to have a better sense of how that risk is being measured relative to history.
Yeah. And
I see another question here that you...
I would say the same. I was just going to jump on to the next question. And maybe you can answer this after me because I think you have an opinion too. From your experience, what has been the best or cheapest way to take down equity risk or volatility risk from your portfolio? Is it SPX, SPY options, VIX futures, cash, US treasuries, or other? I think the short answer is it depends on how you define cheapest. Cheapest from an asset allocation standpoint, meaning most efficient exposures. If you know specifically what you're trying to accomplish, a specific point in time, we'll call it point-to-point precision, I would recommend S&P 500 index options as point-to-point precision for the quarter or point-to-point precision for the year. If you're trying to just remove overall volatility, then obviously VIX futures can play a role, but you have to understand that it's a VIX future. So it's an expectation of volatility versus what ends up being realized. And we can have highly oscillating markets that end up in the same place, or we can have a great distance traveled, meaning we just have prices move really, really far. So there's a difference between volatility that is just fast and oscillating versus distance traveled. If you're trying to play against a distance traveled, I don't want to lose too much money if the market falls too much. That gets you back to that point-to-point precision, and the S&P index options are better. And the VIX futures are all about just kind of using a rebalancer. So I'll give you a real simple example. You buy SPY and you put 95% SPY, and then you put 5% in the VIX future ETF, and then you rebalance it back to 95.5 or 90.10, whatever allocation you want. And you'll notice you have a smooth ride, and it's not a bad strategy. Rebalancing pays for the decay of the VXN ETF, and obviously you get a lower risk SPY, but whenever there's the asymmetry of a market sell-off, the VIX actually is more reactive to the pace at which the sell-off happens, and sometimes the VIX ETN gives you an easier time to monetize your hedge and also just simply rebalance your portfolio. It's also 2 ETFs and rebalancing, so a lot of people find that easy until they have to explain it to a client. Clients like to have it explained to them as a point-to-point precision, because they understand, okay, S&P went down 10% this quarter, I went down 5%, I get it. So I think its simplicity leads you to use S&P options, and asymmetry leads you to use VIX futures. And then the simple allocate SPY, 70% SPY, 30% cash, give yourself a 70 beta is also an easy way and a very efficient, cheap way to get risk management in the portfolio. And the follow-up to this question is there a consistent theme or trade? And again, I think for me, it's simplified hedging, SPX options, or a rebalancer with those 2 ETFs like I described. That's the easiest for people to implement. It's also very efficient and very cheap. The VIX future ETF is a little expensive, but you only have to put 5% allocation into it, whereas 95% of your money is in the cheap Spider ETF. I'll let Stacey jump in. I gave a long answer. Pick either one or the other.
No, I also think, I mean, one thing I would think about just kind of taking a step back just to options or derivatives as a whole, without even getting into the VIX and all of the other ways that we can kind of slice and dice volatility out there. I think it's really important to take a step back when trading any derivative or when thinking about incorporating them into your allocation is, what is the ultimate goal you're hoping to get out of the derivatives? So I always think of derivatives kind of falling into 2 places. There's the income area. So is it just looking for, in the income area is typically with a selling of an option, which typically is going to be the capturing of the VRP. And I know there was a question a little bit earlier that asked, why is it that the VIX, or that we believe that the VIX is pricing in more movement than what actually gets realized? And a lot of that is, sometimes bad events don't happen, sometimes good events don't happen. And I think that's a really important thing. Just because something didn't actually turn out into some sort of movement doesn't mean that the potential for movement wasn't there. And I often think about it with my kids crossing the street. I have all of the bad scenarios playing off in my head, and thankfully, very rarely does it ever happen. And I think that's a really important aspect of VRP that's existing out there, is most of the time the world runs smoothly here. And that's this fear ends up keeping this VRP elevated there. The second reason for options, and this gets kind of to the opposite of the capturing of the VRP, is protection. So you have income, which will give you that VRP, or you have protection, which I would argue gives you kind of the defined outcome. You have a better understanding of what your portfolio will look like in certain scenarios. So we look at these 2 different buckets as, here, what are you ultimately looking for? Understanding that VRP is acting as if you're the insurance agent and you're kind of collecting those premiums with the expectation that very little wrong will happen, or the premiums you're collecting will offset that. Or is it the alternative bucket of, I actually want to pay the premiums because I want to understand what my payoff looks like as we kind of fast forward through time. And there's various ways that you can kind of combine these together. I think a really important aspect from our perspective when we're looking at the markets, and I alluded to this at the start, is we want to better understand what the market is pricing and what the market's expectations are. We don't pretend that we are smarter than the market at any time, but we do believe that we can at least glean the information from the market. And I'll use an example here for you. So the S&P 500, where it currently is very similar levels to what we were at the end of Q4 of 2019, very similar levels. If you wanted to protect your portfolio at that time, it basically cost you about 120 basis points of the S&P 500 spot to buy a quarterly 5% out of the money put. Fast forward to where we are now, 6 months later, we're at very, very similar price levels. But to actually kind of get the tangible concept of how different risk is being priced into the market, that same put costs you almost 4 times as much money. So that's the shift. We're at the same price, but what are we able to glean from the marketplace? And it's the shift in risk, the shift in expectation for movement. The market has since adjusted as the market has kind of had this craziness move around. Sean, did I miss a question in here that as I was chatting with my hand flying around as I said I would? Luckily, yes, nobody got to see.
There was one that slipped in here. I'll take it. It just, in thinking about these strategies, where would you source funds if considered using this in an alternative bucket? So if you, I guess, specific strategies, we were talking mostly about option selling strategies because that's where the opportunity seems to be right now. And there's also option protection strategies where you buy the insurance. I think if you're looking to buy insurance, it's kind of best to just kind of overlay your equity positions and or just add this in your equity bucket, because all you're really doing is taking a lower beta equity exposure anyway. If you're adding an option selling strategy, that's when you get into alternative risk premia, right? That's where you're getting the volatility risk premia. And I think the allocation for that should come out of stocks if you're looking to de-risk because you think stocks are overvalued. It can come out of fixed income because you're worried about rates being, interest rates being low, or just simply a combination of the two, where the volatility risk premium is probably the best opportunity we've seen in several years. But stocks clearly are not the greatest valuation we've seen, and bonds clearly are not the greatest valuation we've seen. So it may be a good time to take it from both of those asset classes, your traditional asset classes, and just keep your risk budget the same if you want. Take a little bit out of stocks, a little bit out of your safe asset bonds, and put it into a volatility risk premium strategy, like a simple put right strategy or a covered call. I would say one of those two strategies is the safest and simplest way to do it. And then once you're in the alternative bucket, I would pair it. I'm not a wine connoisseur, but I would pair it with possibly a managed futures strategy, a convertible bond ARB strategy, or something else that has different alternative, we like to call, and there's enough CFAs on this phone, negatively correlated alpha. And again, they might have no beta, they might have low beta, they might be market neutral. But the question is, when do they do well in an alpha sense, or when do they tend to outperform, or what is a good environment for one strategy and what is a good environment for another? And one of the ways to identify that is with negatively correlated alphas. And these volatility risk premiums probably are set up right now for a good environment going forward, even though recent performance has been poor. And they pair well with other strategies that have different alphas. Trend following strategy, just in case this trend continues and a recovery continues, because both of them could work at the same time. Options selling tends to be mean reverting. And then also some convertible ARBs and stuff like that that are really just dependent on liquidity risk premia. And the fact that there was less liquidity in the market, the liquidity that has now been provided, they could probably tighten up a little bit. But that liquidity risk premium has nothing to do with the volatility risk premium, even though people will tell you that liquidity suppresses vol, which would be good for us, the government liquidity. I think the bigger concern now is the thing that increases volatility is debt. So since we're also adding a lot of debt and the potential outcomes are so wide right now, we could have a really good year or a really bad year. It could be a W, meaning we retest lows and fully recover. We could just go up from here. There's lots of scenarios. But I think most importantly is that you recognize that when debt is added to the economy, it can be an accelerant of the good and the bad, and not just a depressant of volatility like you keep hearing in the press once in a while.
So Sean, we have one other question in here, and I want to make sure that we give Mark and Megan a chance to have some closing remarks here. But I think the question is interesting. It's obviously looking at the risk premium strategies discussed today versus some of the harvesting variance risk premiums. The one thing, and Sean, I want to give you just a second to think about your answer, but the one thing that comes to mind when I'm often asked, like, how is your strategy different than some of these other strategies that I've seen that have been in the headlines, that have been in the newspapers? The biggest difference with strategies that we run is we don't use leverage. There is a big difference. And I know Sean started at the conversation at the very beginning of, you know, we kind of live in a never lever land. Like, leverage within derivatives can certainly, you can get caught when things move much more drastically than the market is anticipating. So there really is, when it comes to using options, really one of the most important aspects of it is understanding what your leverage is. And, you know, in the strategies we run, there is none. I always like this kind of analogy when if you're looking at potentially a short vol strategy and you're trying to better understand what kind of hidden costs are in there, what kind of hidden opportunities are in there that could come back, and you're trying to really be able to describe this. February of 2018, I know Sean talked about this, is one of those examples where how a strategy performed when volatility really changed, when it dramatically increased. You can see the leverage in there that may not have been fully disclosed. And it becomes a very important aspect of understanding a strategy, because leverage does change the outcomes. And I know, Sean, you're chomping at the bit because this is your kind of question. So I want to give you a chance to answer here as well.
Yeah, so obviously I agree with everything you just said. And in true people hate me for this fashion, I'm going to try and take it to a level I should not. Basically, yeah, buy rights, put rights are unlevered. The difference between harvesting the variance risk premium and the volatility risk premium has a lot to do with convexity and asymmetry and stuff. I won't go deep into that, but I think there's a point worth making for people here, and because everyone should be able to understand this, that really what was driving the market in those variance strategies that blew up was you could buy very cheap capped variance because someone, I don't want to say who, was willing to sell underpriced variance caps because they wanted to get the carry trade or be short the left tail. And because of that firm willing to provide it, the best way to think about it is, remember when AIG was willing to provide credit default swaps and collateralized loan obligations and things like that, and they were basically providing insurance for financial products, and the insurance got too cheap. Well, capped variance, the cap piece, got too cheap, which allowed other people to be short variance, driving volatility down because they were able to buy a cheap cap just in case it went against them. And I think that has blown out of the market during March and April. There's also been a lot of assets that shrunk in the tail risk funds because even though they worked, at some point you have to monetize to keep the tail risk from basically going back down after the event. And they lost assets in a couple places. They gained assets in other because, again, recency performance was beneficial. And I think what's important to remember, though, is the market's different today than it was in April. And the biggest difference is there's less suppliers of volatility. And if you go back another layer, there's less suppliers of short volatility caps. And therefore, everybody's kind of in their own risk if they put it on, which means less people will be levered, which means there's less selling pressure on the volatility risk premium, which means you should be able to collect a better than fair premium for a while because the storm just hit. Sorry if that was a little too deep.
No, that's great. And I don't know if we have actually a slide that has our contact info, but I did want to say, if you didn't kind of pick up on it, this is obviously a topic that we love, and we can go much deeper than most people really want to go, and we can certainly keep it light if there are follow-up questions. I want to encourage anyone to reach out to us with any question that you might have, whether it's related to volatility, any products that are out there, anything that touches the derivative space. I want to thank everybody very much for their time and their patience as we dealt with some technology shifts here. And Mark and Megan, I want to turn it back over to you if there are any closing remarks or anything you'd like to add. But thank you very much for the invitation to be here.
Thank you, everyone.
Yeah, thank you, guys. Much appreciated. And just a word to everybody still on the line. If you do want to get in touch with these guys, let us know. We'll be sending out an evaluation after the webinar. And we will make sure that their contact information is available. Again, thank you, Sean. Thank you, Stacey. Thanks to all of the folks at Glenmede. And everybody stay safe, and we'll see you in the near future at another webinar. Take care. Bye-bye.
Thank you.